Hello everyone, I am Dr. Manoj Kumar NV, working as an Associate Professor in the Department of Management Sciences, Maharaja Institute of Technology, Mysore. So today we are discussing about the quantitative and qualitative measures of credit control. The subject entitled that Banking and Financial Services, uh, 18 MBA FM 301. So today the session 4 we are focusing on the quantitative and qualitative measures of credit control. So first, prior we are moving to the qualitative and quantitative measures, we should need to know what is credit control. So credit control is a policy where whatever the credit facilities which is given by the RBI as a central bank or individual banks, those need to be very careful with respect to providing the credit facilities or credit services to the customer. So therefore, the operations, credit operations, which is directly regulated and it is advised by the central board as a RBI guidelines, as well as the committees they are going to be work on with respect to credit control. So therefore, we have measures in under qualitative techniques as well as quantitative measures are there to control credit facilities. Then the quantitative, or it is also called it as traditional method of credit control, that includes the bank rate policy, open market operations, variable reserve ratio, and the qualitative or selective methods, we call it as, of credit control, which includes regulation of margin requirement, credit rationing, regulation for consumer credit, and direct action. So therefore, as an individual or as a banker, there is a need of taking consideration of these phenomena or these measures to evaluate and to know what are the rules and regulations are there with respect to banking terms. So first we are looking to the quantitative methods. In the quantitative methods, where the first one is bank rate policy. The name only indicates it's is a bank rate policy. So therefore, the bank rate is also known as the discount rate. Is the rate which is payable by the commercial banks on the loans from or on the loan form or rediscounts of the central bank. A change in the bank rate affects other market rate of interest. So therefore, whenever the bank rate which is changed, obviously it is impact on the overall interest rate. It might be deposit rate, might be savings deposit rate, or fixed deposit rate, or borrowings rate, or lending rates. These rates are going to be changes once the BRP, banking rate policies, or banking rate, when that changes, it is impact on the other different types of interest rates. An increase in the banker rate, an increase in the bank rate leads to an increase in the other rates of interest, and conversely a decrease in the bank rate results in fall in other rate of interest. So therefore, it will be go vice versa. When the increase in the BRP bank rate, obviously it will be impact on the other rates also will be goes up. When it is declines, the other rate also declines. A deliberate manipulation of the bank rate by the central bank to influence the flow of credit created by the commercial bank is also known as banker rate policy. So once again I will repeat, a deliberate manipulation of the bank rate by the central bank to influence the flow of credit created by the commercial banks is known as bank rate policy. It does so by affecting the demand for credit, the cost of the credit, and the availability of the credit. So therefore, here as a banker, they can able to focusing on how these factors are influenced, how the market demand for the credit, and based on that they are going to be decide whether to give what proportion they have to mention, at what rate they are going to decide that they are going to be focusing on. It continuing that with respect to banker rate, an increase in the bank rate results in an increase in the cost of credit. As I said, when the bank rate increase, the other interest rates also goes up. So therefore, the cost of the credit will be higher when the bank rate increase in the market. So therefore, we should be very careful. Even though we are running an organization or we are running a bank, we must be very careful with respect to the credit facilities which is providing by that. It depends on the bank rate policy. This is expected to lead the contraction in the demand for a credit. So therefore, when we are considering a credit facilities, it is depends on the bank rate. So when the bank rate increasing, all other rates are increased. So therefore, the market demand for the loans become reduced. So therefore, there is a need of understanding the bank rate, which is helps to the banker to know at what sort of the level of credit creation which is happening and how they are going to be provide the credit facilities at the different rates. In such as the bank credit is an important component. It is an important component of aggregate money supply in the economy. A contraction in demand, so as I said, it is go with the flow of demand and supply. When the demand is high, obviously there is a low rate of interest. When the rate of interest is high, the demand will be low. So therefore, the demand and supply will balance the economy. So therefore, a contraction in the demand for credit consequence on an increase in the cost of credit restrict the total availability of money in the economy. So therefore, as a country as a whole, as the Indian economy, they are going to be take the control to balance the economic condition by understanding the demand and supply with respect to considering the banking rate policy, and hence may prove an anti-inflationary measure of control. So why we call it as anti-inflationary measure of control? Where we are balancing the economy by fixing, increasing or decreasing the bank rate, that is going to be helpful to us to have a proper money supply. When that money supply which will be in the equilibrium, then the country they can go with the best economy towards the development. Then likewise, as same like fall in the bank rate causes other rate of interest also come down, as we already discussed that, where when the bank rate is declines, then the other rates also declines. The credit falls, the cost of credit falls, that is, and credit becomes cheaper. So means when the bank rate declines, obviously the other interest rates also declines. So when the interest rate declines, the credit availability is very easier. Every banker, they are expecting to provide the credit facilities. So therefore, cheaper the credit may include high demand for both the investment and consumption purpose. So therefore, anybody who are interested to take a loan, they take a loan and they are make an investment, as well as for the consumption purposes also, there will be a higher demand for cheaper credit. So more money through increased flow of credit comes into circulation. So therefore, here the circulation of the money will be high. the circulation of the money will be high when the banker rate is low. When it is improved, when the rate is increased, obviously the money flow will be lower. So therefore, when there is a more circulation, so we can easily get to know that the banker rate is lower. So therefore, that will be helpful to the market to understand how the banker rate is most important. Either they may go for investment, or they may go with the consumption by using the cheaper credit. A fall in the bank rate may prove an anti-deflationary instrument of control. The effectiveness of the bank rates as an instrument of control is, however, restricted preliminarily by the fact that both the inflationary and recessionary conditions, the cost of credit may not be very significant factor influencing the investment decision for the firm. So like when we have a recession or inflation in the economy, the banker rate is not only the major significant factor which is influenced to investment pattern. So therefore, it depends on how individual perception with respect to the credit facilities rather than only considering the rate of interest. Then we are moving to the second one, where we are concentrating on open market operations. So everybody, we know open market operation, it is allowed each and everybody to transact in the open market in terms of securities. As we know, the open market operations refer to the sale or buying of securities by the central government to the commercial banks. A sale of securities by the central bank, that is the purchase of securities by the central banks, result in a fall in the total cash reserves of the later chances. So like whenever they go for investment, then the central government, they are going to buy or sell the securities in the open market on behalf of commercial banks. So therefore, a sale of securities by the central bank and the purchase of the securities by the commercial bank. So means here central bank perform as a seller and commercial bank performed as a buyer. So in the open market, the RBI central bank here is in India, we have a RBI as a central bank. So the central bank, they are going to purchase or they are going to sell the securities, and the commercial banks, they are going to buy the securities from the central bank. So therefore, when they do this transaction, the commercial bank cash reserve ratio become lower. So therefore, the proportionate of the CRR cash reserve ratio, which is going to be make an investment and to buy the securities from the central bank. So therefore, even though it is not affected immediately, but in future the cash reserve ratio have a fall due to when they go for open market operation. When they do purchase of whatever the sales securities by the RBI, the cash reserve ratio of the individual banker become lower. A fall in the cash reserve ratio leads to a cut in the credit creation power of this commercial bank. This is most important, where when the cash reserve ratio means the proportion of the liquidity maintained by the individual banker as per the guidelines given by the RBI. So the liquid cash, retaining a liquid cash reserve ratio in the bank, that is we are consider that as cash reserve ratio. So therefore, whenever there is a shortfall, when there is a declining in the cash reserve, total cash reserve ratio, that will be result in less credit creation power. So because whenever they are investing their own reserves, obviously they are lacking with the sufficient funds to provide the credit facility. So therefore, whenever there is a fall in total cash reserves, then obviously it will be impact on the credit creation power also declines. So with reduced cash reserves at their command, the commercial banks can only create the lower volume of credit. So as I said, when they do investment their own reserves, they are not have a sufficient funds to give a loans. So therefore, as a banker, they properly need to be maintain the liquidity in terms of cash reserve ratio that will gives more liquidity power to the banker to provide the financial services. So therefore, to provide the credit facilities, the banker must need to be very careful to maintain the cash reserve ratio. If they are fall in the cash reserve ratio, that is resulted in lower the volume of credit. Thus, sale of securities by the central banks serves an anti-inflationary measures of control. So means it is one of the technique of the RBI to balancing the economy, to balancing the inflationary system in the money flow, increasing in the money flow or decreasing in the money flow in the market, that is going to be controlled through open market operations. So the open market operation, which is helpful to the central government, by issuing the securities, they are going to get the cash. So therefore, when they are collecting the cash, they know that the intention of selling the securities to the commercial banker is the flow of money is very high. When it is very high, the RBI take a decision to sell the securities and they get back the cash. Once they are get back whatever the excess cash which is transacted in the market, obviously the economy will be balanced. So the even it is working as a anti-inflationary measure of control. Likewise, a purchase of securities by the central bank results in more cash flowing to commercial banks. So here whatever they do purchase of securities by the central banks results more cash flowing to the commercial banks. So therefore, what happens when they are get back their whatever the purchase made by the central commercial banks, then they are going to sell the particular securities in the open market. When the Reserve Bank itself they are going to buy the particular securities, there will be a chance of more cash flow. So when they are creating more cash flow, because it is a transaction between the RBI and commercial bank. So when the RBI they issued the securities, means they are selling the securities and commercial banks are buying the securities. At that time, the commercial banks they are going to use their CRR to make a purchase of the particular securities. So obviously it will make the shortfall, it will make declines in the CRR proportion. So therefore, they are insufficient to provide the credit facilities to the people. But in case vice versa which is happened, like RBI take a chance for buying the securities and commercial banks they are ready to sell the securities. At that time the commercial banks are going to sell at a high price. So obviously which is resulting in more cash flows to the commercial banks. So therefore always, even though that makes the cash reserve proportion is lower or credit facilities become lower, still the commercial banks they are prefer to go for open market transaction as one of the investment mode to increase the rate of return to the banker. So it will be helpful for them to enter in the open market operation. So with this increased cash in their hands, the commercial banks can create more credit. So like just assume that at present CRR is 3%. So means for 100 rupees they have to be made at least 3 rupees need to be kept it as cash reserve in the banks. So here if they are used 50% of the CRR for making an investment in the open market operations. If they are lending the same proportion 1.5%, it may earn up to 6%. But if they are investing in the open market transactions or operations, surely the rate of return will be very much higher than whatever we are getting from lending a loan. So therefore, it will boost the cash flow to the banker, as well as it may create more credit and more finance which is available in the commercial banks. So therefore, thus the purchase of securities may work as an anti-deflationary measure of control. So therefore, every banker must need to be concentrate on open market transactions. Even the RBI, Reserve Bank of India, has frequently resorted to the sale of government securities, to which the commercial banks have an generously contributing. So maybe whatever the government securities which are issued by the RBI, those securities are mainly contributing by the commercial banker. So commercial banks, they are very much interested and ready to invest on the particular sale of government securities by the RBI. Thus, the open market operation in India have served on the one hand as an instrument to make available more budgetary resources, and on the other hand as an instrument to spin off the excess liquidity in the system. So here we can focus into majorly two considerations. One is budgetary resources. So whenever we have a proper resources, then we can able to take the control and we can be able to do the investment in the open market, or else it is one of the most important consideration to spin off the excess cash. So means what? If the banker receiving 100 rupees as a deposit, out of which he kept 3%, 3 rupees as a CRR, then whatever is given a lending for the particular day, it is not exceed more than 30% or 40%, then remaining will be 60% or 70%. So therefore, instead of retaining the excess cash in the bank balance, that is not going to yield anything. It becomes a dead investment unless whatever the deposit you are received, if you are not properly given as a credit facilities, surely the banker become a responsible and liable to meet the particular interest. So therefore, it shows the inefficiency. So therefore, the banker must need to be focused on what is the minimum requirement of liquidity which is required. That much amount only they need to be kept in the bank, and the remaining thing that better to invest in the open market operations, that is always going to be contributing greater than whatever the lending rate of interest. So therefore, it is working as a two major phenomenon. In one hand, it is an instrument to make available for more budgetary resources, as well as in the second way, where it is an instrument to spin off the excess liquidity in the system. So therefore, it will always going to be work in the two direction. One, you can make use for more budgetary resources, and the another instrument you can make use for spin off the whatever the excess liquidity you have, you can able to make the investment of it. Then coming to the third quantitative measure of credit control is variable reserve ratios. So variable reserve ratio refer to the proportion of the bank deposit that the commercial banks are required to keep in the form of cash to ensure liquidity for the credit created by them. So means what, as we discussed in the previous point, where the cash reserve ratio plays a major role in the open market operations, because the excess cash more than greater than the limit of the CRR that you are going to be make an investment in the open market operation. But here we are mainly focusing in the variable reserve ratio. Here we are mainly focused on the part of CRR. So it clearly describes that the bank deposit that the commercial banks are required to keep in the form of the cash to ensure the liquidity for the credit created by them. A rise in the cash reserve ratio results in the fall in the value of deposit multiplier. Conversely, a fall in the cash reserve ratio leads to a rise in the value of deposit multiplier. So means what, where when the cash reserve is high, then the lending proportion will be low. So therefore, when the cash reserve is fall, the value of the depositor multiplier also will be, so when the cash reserve ratio is rise, then there is a fall in value of deposit multiplier. Conversely, when the cash reserve is ratio is rise, then the value when the cash reserve ratio is declines, then there is a more value deposit multiplier. A fall in the value of deposit multiplier amounts to a contraction in the availability of credit, and thus it may serve as an anti-inflationary measure. As we discussed in the previous one, open market operations, that is discretionary or deflationary measure, but when we considering a variable reserve ratio, it is a anti-inflationary measure. So therefore, it is control the entire economic system. When the inflation which is taken place, it is work as a anti-inflationary instrument. A rise in the value of deposit multiplier, on the other hand, amounts of the fact that the commercial banks can create more credit. So as you know here, when the rise in the value of deposit multiplier, so when the rise in value of deposit multiplier, the CRR proportion is low. So means what, they are getting more interest. So therefore, when they are getting more interest, obviously the depositor are interested to make a savings and they do the investment. So therefore, it will be affecting on creating amounts to the fact that the commercial banks can create more credit and make available for more finance and for consumption and investment expenditure. When the deposit is increased, obviously the bankers, they are concentrating on providing more loans. When they are providing more loans, there will be a chance of financing for instrument, for investment expenditure and for consumption. May all a fall in the reserve ratio may thus work as an anti-deflationary method in the money control. So therefore, whenever there is a chance of declining the value of the domestic currency, then they must, even though they must need to be charged very high, then they must need to be concentrate on when there is a rise in the value of multiplier. The Reserve Bank of India is empowered to change the reserve requirement of the commercial banks. As I said, whatever the supervision function or monetary function or directive function, all the functions are made by the RBI, and the RBI clearly states and ground the and control the commercial banks, where they are going to be empowered to change the reserve requirements of the commercial banks. The Reserve Banks employs two types of reserve ratio for the purpose, which the statutory liquidity ratio and cash reserve ratio. These are the major two ratios which is governed and which is implied, suggested implied by the all commercial banks, and it is regulated by RBI. So the first one in under the variable proportion ratio is the statutory liquidity ratio, refers to the proportion of aggregate deposits which the commercial banks are required to keep with themselves in the liquid form. The commercial banks generally make use of this money to purchase the government securities. Thus, the statutory liquidity ratio on the one hand, it is used to spin off the excess liquidity of the banking system. In the other hand, they make it use for mobilize revenue for the government. So therefore, here in the statutory liquidity ratio, whatever the aggregate deposit which the commercial banks are raised, that aggregate deposits in the liquid form, they need to be make it as statutory liquidity ratio, and this liquidity ratio, statutory liquidity ratio, which is used for making an investment in the open market transaction, that too with respect to purchasing the government securities. So therefore, SLR used in the two ways. One is you can spin off, so means whatever the deposit you are received, you are accepted the deposit, out of that money, whatever you kept it as a liquid form of the cash as a statutory liquidity ratio, that you can able to invest that in the open market operations as the excess liquid, or whatever the excess liquidity you had, that you can able to make it into investment, as well as in the other hand, it will be used to mobilize the revenue for government. So therefore, the government also, they may use that money whenever there is a need of economical or financial emergency. The Reserve Bank of India is empowered to raise the ratio up to 40% of aggregate deposit of commercial banks. Presently, this ratio stands at 25%. So earlier they are expecting, prior to the committee resolution passed, they are expecting to have a SLR at 40%, but at present the commercial banks, they go with 25% of the aggregate deposit as to be considered as a statutory liquidity ratio. Then the second one under variable reserve ratio is the cash reserve ratio. The cash reserve ratio refers to the proportion of the aggregate deposit with the commercial banks are required to keep with the RBI. So SLR, where they are going to create the proportionate of aggregate deposit and they keep that amount with them as a liquid cash or liquid form. But in the cash reserve ratio, whatever they are calculated the proportion of aggregate deposits of commercial banks, that proportionate of the reserve, that must need to be kept with the RBI. So therefore, at present the RBI stands with the CRR ratio for commercial bank at 3%. So coming to the rates, what are all the rates which is fixed by the government or commercial central bank as per the latest updates? As per 28 August 2020, the CRR under the variable reserve ratio, the CRR is 3%, SLR statutory liquidity ratio is 18%, Repo is 4%, reverse repo is 3.35%, marginal standing facility rate is 4.65%, and the banker rate is 4.65%. 0.65%. So therefore, all these statistics which clearly states only the commercial banks only retain the aggregate deposit of 3%. Aggregate deposit of 3%, they must need to keep with the RBI, and they must need to be retained 18% of reserve of aggregate deposit as a SLR, statutory liquidity ratio, and they must need to keep themselves as a liquid form. So therefore, they can maybe have a chance of make use for purchasing a government securities. And repo, which is reported 4%. Repo, the rate whenever the RBI they issue the loans, they are providing the loans to the other bankers, the rate which they are going to fix is repo rate, repurchase agreement rate, where it is 4%. And we have a reverse repo whenever the government is lagging or RBI, they are facing a financial problems or financial instability, then they go for borrowing the amount from the other bankers, indigenous bankers, or it might be commercial banks, it might be nationalized bank. They are going to lend from them, they are going to be take the loan from them at a 3.35%, that we call it as reverse repo. And bank rate we call it as, that is 4.65%. Whenever the banks are go for rediscounting, then they must need to be charged 4.65% from RBI. Then coming to the next part, that is qualitative measures. These qualitative measures had three major tools, where we have a regulation of margin requirement and credit rationing, regulation of for consumer credit, and direct action. These are, we are going to be discuss these in the next coming class. So today we are concentrating on only the quantitative measures of credit control. Once again I will repeat how it will be relevant and how it will have a flow, and how who are guiding and who are taking a direction towards positive steps towards using these measures to control the credit. So in the quantitative measures, majorly we have three types, where the banker rate policy, open market operations, and variable reserve ratio. So the banker rate policy, it is whenever the commercial banks they go for discounting of bills, then they must need to be consider the bank rate policy, where the bank rate policy, which is mainly concentrate towards whenever the commercial banks they go for discounting the bills, then they make use of the bank rates. So it is mainly, it is also called it as discount rate, is the rate which is payable by the commercial banks on the loans form from or rediscount of the central bank. Then coming to the second one, open market operations. Open market operation, which is allowed both the players like central bank and commercial banks. These two major banks, they are performed as players in the open market to buy or to sell the securities. So whatever the securities are sold by the central bank, that is going to be buyback again from the commercial banks. So it depends on balancing the economic system. The government, the RBI, which is taken the position in the open market to control the excess cash operations. So in the open market operation, we have two types of transaction. One is the first one where the central bank, which they are going to sell the securities, and commercial banks they are going to buy the securities. So whenever the central bank, they are planning to control the excess money in the market, then they are going to sell, and commercial banks, they are going to buy that through their SLR, whatever the SLR or CRR reserves are there, they are going to buy the particular securities. When the market is not have a sufficient funds or money flow, there is a insufficient or inefficient money flows in the market, at that time the RBI buy the securities as per the market value from the commercial bank. So therefore the flow of the money will be more for the commercial banks. So when the flow of money is high, then credit facilities are more from the commercial banks. That is helpful to the individuals to get more credit facilities from the commercial banks. Then the last one is variable reserve ratio, where majorly we have a two variable reserve ratio. One is SLR and the second one is CRR. SLR is a proportionate aggregate deposit, proportion of aggregate deposit which is prescribed by the RBI, and that reserves should need to be kept it in the particular bank as in the liquid form. So therefore presently the SLR, which is as per the RBI, it is stated it is 18% for the commercial bank, and the second one is CRR. CRR also a proportionate of aggregate deposit, but it is not in the hands of banker, it will be handed over to RBI. So therefore the present rate of CRR is 3.5%. So hope everyone you are understand today's whatever the quantitative measures of credit control in the banking system we have. So this is always helpful to the individuals, bankers and business as well as professionals to take the credit facilities from the bankers, and bankers, they can able to ascertain what amount of the cash they must need to be retained and how much they can able to provide the credit facilities, whether it is feasible to go for open market operations or not. These are the major decisions they can able to do, and even as an individual we can able to know that how the bank operations are going to be take place, how the interest rates are framed and how it will be have a variations. These sort of the things we can able to know by understanding the conceptual base of the quantitative measures of credit control. Thanks for your listening. Thank you all.